Starting just a recording session that I did one day before this presentation going live. And so we wrote a letter recently, and I would like to go through a few charts that I think are fairly new, and also hopefully share some of our opinions. Share my screen in a second here. All right. So let's get started. I think the case for this presentation, the title really is the bear case for the US dollar. So let's get started on this. The first chart that I think is relevant to begin with is the US gold reserves as a percentage of government debt. I mean, these types of calculations had not been very relevant in terms of trading or investment decisions. If you made an investment decision with the fact that the US only holds 2% of gold reserves relative to government debt, that has been a terrible decision. But there are times in history when these types of calculations begin to matter. When you hear Scott Basson talk about, and this is from an interview right before he actually accepted or was nominated as the Treasury Secretary for the Trump administration's second term, he mentioned very clearly that he would like to be part of a new monetary alignment globally. And I found that very interesting, and there are many angles of that view. But more importantly, this is why charts like this start to actually matter. And the calculation here is just looking at gold reserves relative to government debt. Back in the 1940s or so, a little bit before the World War II, we were about 40% of all government debt outstanding was backed by gold. And then, leading up to the war, we saw a surge of money supply and also a surge of government debt, which caused this number to fall. And later on, we had the war, and after the war, and then we hit 1970s. The 1970s period was another time when not only gold prices increased, but really what happened at that time was the fact that we saw a 17% again increase of this number. Today, given the fact of how much government debt has grown relative to the gold price increasing, that number has not gone anywhere, which is remarkable. So we're now at a 2%. And by the way, I just want to be very clear, none of these numbers are hypothetical numbers or price targets of where gold should be. It's just a study of where, throughout history, we've seen if we ever go back to those gold reserves relative to government debt levels, what would that imply gold prices today? And if we go back to the 17% number, clearly we're about $24,000 an ounce. Go back to the 40% level, which is a more extreme situation, we're back to $55,000 an ounce. Now, I may argue that this is not as extreme, perhaps, because of the white line of where you're looking at the government debt to GDP, where it's higher than the World War II levels. And so I guess if we're going back to a disciplinary age of fiscal and monetary policy, I guess it would be plausible that we would get it back to some of these levels in terms of reserves relative to government debt. Another thing that I think it's remarkable actually in terms of research is you've got two lines here. The blue line is international central banks, and then the yellow line and the first panel of this chart, you're looking at US gold reserves, so separated the two. Notice in 1957 or so, the US had more reserves than the entire world combined. And then I pointed out at the end of the gold standard in 1971, what exactly happened during that period. We didn't see really international central banks buying gold. In fact, we saw actually selling of gold after that era. Same thing happened with the US. And then things sort of stabilize in terms of the US. And we haven't seen a change in policy, at least that we're aware of or reportedly aware of. And so the yellow line is today at its lowest level in 90 years. And the blue line is rising. It's been rising since the global financial crisis, and it's now at its highest level in 49 years. I mean, this is a real change in policy from the rest of the world versus the US. And you can see down below in the second panel of this chart, the percentage of US relative to the overall gold reserves globally. And we used to be about 53%. Now we're back to close to 20%. And I noted, I guess one of the points I make in this chart is that the US has opted out of the global gold buying spree. And I really mean it. I think that we're on the verge of seeing some big changes in policies that could surprise a lot of people. Now, one of those things that don't happen in 50, 70 years, and then you see a policy change. That's where I believe we're on the verge of. Now, a few things have helped the dollar, and also I would say also cause issues in terms of the extreme of, I just showed you that we're at a 90-year low of gold reserves. At the same time, when you go back to the global financial crisis, which was a time when most central banks started to buy gold outside of the US, we also saw something called, what a lot of people call, American exceptionalism. We saw a period where US equities have done very well. I call it fiscal irresponsibility, because clearly with the data, if you looked at in average, the US has spent a lot more than other countries when it comes to government spending relative to GDP. And this is relevant because the U.S. is holding the reserve currency status with the dollar, allowed them to actually use a less disciplinary approach relative to the rest of the world. But those things, they can only last for so long, and therefore why we're seeing a push towards a change in that direction. The thing is, when you have government spending to that degree, it creates an engine of growth in the economy, and therefore why you're seeing in this chart the valuation of U.S. equities at very extreme levels. So you're looking at price to book, and I have it separated by countries, and you have the Nikkei, the German stock market, the French stock market, the Brazilian Ibovespa, the Korean stock exchange, and all these other, and I have all this the pack down below, what I call the rest of the world and the US. Clearly, there's a big divergence, a disparity of multiples that I believe is being caused by one agent, which has been not only technology advancements, but really, in my view, much more intensified by the fact that we've seen so much government spending in the US. And so it becomes a question when back in the days, you used to have all these list of pillars that have been supporting that red line. You're looking at the chart. It used to be NIRP, near zero interest rate policies. You used to have even at some point negative real rates for a very long time in the US. And then we had an expansion of the monetary base, a large increase of money supply domestically and globally. So all these things have caused the red line to rise substantially. And today we're all these different pillars have been taken out. So, first was interest rates. We're not seeing rates, at those levels that used to be to justify multiples at the levels that they are currently. We're not seeing the Fed really print money as much as we used to see before. In fact, we're seeing the balance sheet of the Federal Reserve to shrink. You can look at the global central bank assets just to see liquidity from a broader standpoint. It's also falling. Money supply has been falling as well, globally especially, and mostly a function of the US dollar, just to be clear. And, I believe that the last engine or the last pillar that has been holding up this red line has been government spending. Now we're talking about DOGE. We've been talking about all sorts of policies to reduce government spending substantially. I question if the red line should be where it is. I don't think it should be. So, when you think about what we call the rebalancing, the global rebalancing in this letter is really because of the world, has been essentially been neglected, the rest of the world relative to the US, which has the so-called milkshake theory has sucked all of the capital outside of the world. And as you can see in this chart very clearly today, MSCI World Weight has the US at about 73%. Rest of the world are all single digits, as you can see. So Japan, which is the highest at 6%, is more the US is more than 10 times the weight of the second in place. So these are pretty extreme numbers that I think are completely, folks try to justify these types of imbalances. But, what is, how do you even come up with the thesis to go from 73 to 75? I mean, it just seems, I call this asymmetry. I mean, there's no name for it outside of asymmetry when it comes to investing outside of the US. And I believe that this is all comes down to the dollar. And this is why this presentation is so focused on the dollar. When I look at this chart, and I've showed this chart before, to me, it's the most, if I was a policymaker, and I do think they are aware of this chart in terms of not coming from me, but really the administration actually focused on this specifically, has to do with, the main imbalance we have. It's not the debt to GDP level, but really how much we're spending to service the debt yearly. And in this chart, you can see the US is spending close to 5% of GDP. The second economy, which would be Greece, is, almost, half lower than the US. And so, and a lot of other pretty large economies are substantially lower than the US as well. So you can see that there's a greater sense of urgency for the US to lower rates. And this is sort of a chicken and egg question, because, you can work on, reducing fiscal spending in order to cause interest rates to fall, which is what Scott Bessent has been talking about. But the other way around this would be, clearly, if you just bring interest rates lower, it would actually cause one of the largest buckets of government spending in terms of wasteful would be the interest payment to GDP. That would go away, or at least be reduced substantially. The US needs to bring it down, this number, in my view, at least in half. And so, there's a lot of room for changes in interest rates from here that, in my view, would have an impact on the dollar. And so what is the usual outcome of austerity combined with lower rates? And one thing that I learned is especially coming from folks like Druckenmiller, by no means this is a formula you should follow, and it's not certainty or anything along those lines. But it's something that is, struck to me back in the 90s when those guys, Paul Tudor Jones and Stanley Druckenmiller, used to talk about how, strong government spending alongside with strong monetary policy, or I should say tight monetary policy, tends to cause the dollar to rise. We have precisely the opposite of that combination. We have austerity combined with lower rates, one causing the other. Again, the chicken and egg question. The lower rates causes austerity, as at the same time as Musk is in a way, talking about Doge and all that, but really masks the idea of lowering rates itself, that then causes the government spending again to be reduced. The ultimate formula, in my view, that causes a weaker dollar. And, if you listen to Bessent and other folks that have been talking about this drop in 10-year yields, the media has been all over this. There has been no shortage of coverage on the 10-year yield. What has been shortage of coverage has been on the dollar. But the two has been trading quite closely with each other, as you can see in this chart. The blue line has been falling and the white line has been falling. So the dollar has been actually declining relative to other currencies more recently. In fact, this chart's slightly old. The white line has been collapsing more recently as well. We've had in the last 2 days, we had the two largest 2-day drops. I'm sorry, the largest 2-day drop in the DXY index in 2 years, in over 2 years. You go back in history, these kind of levels of two-day declines are not usual. And when we see those, they tend to cause these downward trends as well. So I think this is extremely meaningful, and I'll explain why in a minute. When you look back in history, this might be one of the most important charts of this whole presentation. This is a way to measure the valuation of the US dollar. It's a real trade-weighted index that the Fed actually calculates in R-Growth Infinity, provided the data going back to the 40s, before that era, because I can only go back to the 1940s on the data that I have access to. So I thank them for providing this data, and and also for their approval for me to use this. But if you look at this chart, it's also, I think, remarkable. You can see two peaks in history outside of today. First, anyway, the first thing that comes to mind is that we're extremely overvalued historically, going back 100 years, over 100 years. We've only seen two other times that the dollar was this overvalued. It's funny to me when I hear people talk about the dollar is the cleanest of all dirty shirts with so much conviction. It's almost like, okay, you've been reporting what just happened in the last 5 to 7, 10 years. That's not investing. Investing, in my view, is understanding what's likely to happen, not just explaining what just happened in the past. And so I'm trying to use those lenses, because when I see something have such a large movement like we're seeing now, I believe it's time to start, growing conviction in a view that I've been growing in the last, call it, 5 to 6 months. And I think it's starting to play out in a way that could be very meaningful for markets. Those two peaks that you're seeing in the screen, one of them was 1985, where we saw a coordinated act across central banks to reduce the valuation of the dollar. That inflated the Japanese market, real estate market, equity market. We saw bubbles in emerging markets. So the fall of the dollar it really causes a rebalancing. The people sell the dollar and start buying the rest of the world. And I think we're going to see something similar. Now, you go back to the 1930s, which to me is even more interesting, is because we were in the middle of a global recession. We were in the middle of the global depression, I should say. And 1929, markets peaked. And then 1931 came along. 1931 was a period where the whole market was, in this meltdown, stage. And a few economies like the UK, Japan, Canada, Germany, Austria, pretty large economies of that time, decided to break their gold standard domestically. So immediately on the back of those policy changes, we saw the dollar surge. Makes sense. If those guys lost completely their discipline, then the dollar began to surge. Then back in the 1933, there was some attempt to coordinate things across central banks to try to revitalize the global economy and come up with policies that would potentially especially on the trades front, and maybe even in the monetary side, trying to really revitalize the global economy. But guess what? Roosevelt at the time came out of that London meeting, was meeting in London across most monetary authorities and fiscal authorities of the world, and basically gave up on those on that cooperation globally. And right when he came back to the U.S., he decided to devalue the dollar versus gold, and that was basically what caused the dollar to peak as well, and pretty much marked the end of the global financial crisis of that time. And so I think there's some similarities with today in that front. Not that we're in the Great Depression, but the fact that the global economy outside of the U.S. has been pretty stagnant. And then you can see that, not to go back, but look at this chart. This chart, I think, is a good example of that. You can see the rest of the world has been stagnant, and then the red line is the U.S., which has been ahead of everybody else. And so you've had this already an attempt to, or I should say, most currencies outside of the U.S. dollar have already devalued substantially. The Japanese yen, the euro, the Canadian dollar, the Brazilian real. I mean, I was just looking at real estate in Brazil. It's down 50% from its peak, mostly because of the dollar. And it's just one example. I mean, you can look at a lot of other countries that are facing the same issue. And so you start to look at this, it makes sense that we're at a peak. Now, the question is, can we continue to have that? And we know Trump's, views about the dollar, or at least from his first administration. We know that there are some hesitations of, speaking openly about devaluing the dollar. It makes a ton of sense to me that they shouldn't be directly targeting the dollar. But in my view, what we're about to see is that this policy that is so targeted on interest rates is really hiding a bigger target in my view, which is also lowering the dollar. So when you think about, okay, what's been causing the dollar, if the dollar starts to move and starts to actually change directions, which is the blue line now that you're looking at, that's the dollar. And then you have the other chart is basically commodities to equity ratio. So it's a index of commodities, and then you look at relative to the S&P 500. I've used this chart many times, and I think it's one of the most important lines or charts or measurements that an investor should be focused. It's what brought me the conviction to invest in commodities. Most people that look at this chart will usually say the following: say, well, I've been looking at this chart for many years and it never works. But the big question is, why hasn't it worked? And the reason's right in your face, right here in the blue line. And the blue line has not turned. So if the dollar keeps going higher, it makes no sense that the yellow line, the white line, is going to turn as well. So we're now at a change here. There is a clear push to reduce the valuation of the blue line. So if that's the view, then what does that do to the white line? I think we're in the beginning of, again, a rebalancing, but also what I view to be a secular bull market for a lot of hard assets. And so it's not just gold. And I think why I'm so focused on, I think gold is the green light for a lot of its derivatives that have lagged substantially. And another thing that is important when you take a look at that chart, it makes you think about as well about the equity markets in the US have been very expensive. You can see here is a great example is looking at the CAPE ratio, the cyclically adjusted PE ratio by Robert Shiller from Yale University. And this is a great way to sort of step back and see valuations. And you can see here that the US is by far the most expensive. There are other economies like India that actually surprisingly are pretty high in terms of valuations, although they do have a lot of growth. And so maybe there's ways to justify that. But this is why I tend to focus more in the far right of this chart, where you have especially countries like Argentina, Brazil, you can see South Korea and some other economies that I think look a lot more. Even European economies have had valuation of the US. Now, what is remarkable is if you take the US, which is already very concentrated, as we all know, with mega caps, and then you take that US stocks alone, they have a CAPE ratio of almost 60. And that's insanely expensive, because if you do an empirical analysis of when you reach those valuations and what's the return after that, you tend to see pretty diminished returns over the next 10 years, if not very negative, by the way. I should say it's actually historically has been very, very negative. But I don't, I don't want to also paint a color of being extreme. I think it's extremely bearish. I've never seen concentration, end well in markets. We've seen a few times, but arguably this is probably one of the most concentrated markets we've seen in history. What are other derivatives? And you can see here in this chart, points you to emerging markets. Okay, well, look at gold and emerging markets. They have a pretty clear correlation. So yellow line is gold, obviously, blue line is emerging markets. And you can see that emerging markets all the way back to 2007 or so, the global financial crisis, they have been going sideways. It's been in a major, major consolidation. And what I like about charts like this is that people have completely ignored this blue line. They think it will never go up again. And they think majority of folks have lost faith on things like emerging markets, the mining industry, silver, just because they haven't moved in a very long time. Now, I like to, I wouldn't say the word necessarily bet in history, but really rely on history. And when I looked at this chart, clearly these types of instruments, emerging markets, silver, mining stocks, they tend to be the high beta versions of gold. And so would it shock me if we see that rebalancing of the dollar causing this blue line to actually go a lot higher? No, it wouldn't shock me at all. And in fact, that's one of my main views. I am extremely bullish emerging markets. I think when you have the two main issues for the blue line are usually emerging markets tend to suffer in periods when the dollar is strong, and then you also have yields rising. And I think we're in a period where the US has one big priority, which is capping those two things. And as we see that occurring, I believe that the blue line is going to benefit tremendously, and it's going to be a green light for emerging markets overall, in my view. Mining stocks, another thing that should be beneficiating from this environment as well. Something that people don't talk a lot about, but the cost structure for mining. Maybe we're entering what I call the golden age of mining. What a wonderful environment to be producing metals when gold prices are almost double what most of these companies are paying to produce. And I know some people like to say, "Oh, Tavi, you got to add a few CapEx." It's not much. There's still, increase in the bottom line of these companies. And to me, that what it means is in the following charts, I guess. Well, you can see, I mean, this is another example, the gold to oil ratio, second largest level in history. We're seeing gold rising substantially. Oil price is actually falling. It's in the 60s, which is a little shocking to me too. And I'm not going to lie. I have given my views on hard assets and commodities. It's something I've been wrong here recently. And I actually think it's an opportunity as well, and especially the producers of oil. But nonetheless, that this ratio has been so high that it creates incredible margins. Maybe even Quentin can comment on some potential impacts in mining companies when you have gold to oil ratios at those levels. Majority of that, from my research, is usually comes from open pit projects that tend to have a pretty high energy cost, and so I would suspect that that would also benefit those companies. Now, the white line now is showing that profitability. It's a cash flow per share estimate, which explains a lot recently why mining stocks have been underperforming gold, is because their bottom line has not improved. Now, notice the recent increase that we're seeing. Notice that jump from pretty mediocre levels, like around that, pretty close to where the share prices are trading. And then recently we had a jump in prices or in cash flow per share estimate, which is, and by the way, the realized cash flow also saw a major jump. Now I'm happy to show that too. But you can see here, we're now almost at all-time highs, and the share price of these companies are all 50% from their prior highs. Now, each person will have their own interpretation of this. I'll give you my interpretation. I think there is an opportunity for a major catch-up, and I'm laser focused in these things, because I do think we're seeing something very special for the mining industry. Now, more importantly, if you recall, and maybe a little bit self-promotional here in the sense where Crescat has been deploying capital. I mean, we deploy a lot of capital in exploration stocks, so I want to get that out of the way first and foremost. But it's also important to put real research out there when it comes to understanding stocks and how things usually tend to perform in different times. Exploration stocks tend to have really high risk, but also, a lot of times provide most of the big returns in the industry. Majority of the billionaires in this industry made their money in exploration stocks. So a lot of them, purchase shares of companies at early stages that end up finding major discoveries. And then when you catch that cycle of mining, you tend to see pretty large increases in share prices of these types of, high risk names. Again, cycle needs to be right. If you're wrong about it, those are the things that also fall the most. Now, what is interesting about this is that when you start to see the seniors making money, which is what's been happening, this is cash flow as well in yellow. You can see that there's a correlation between that and explorers. Immediately, the market starts thinking, wait a second, these guys are going to deploy capital into the blue line. But this time around, I would say that it's even more relevant, because you also have a time when most of these companies have not replenished their reserves in a very long time. The quality of their reserves have been deteriorating quite substantially. So there is a need for them to actually pursue even more M&A. And I do think we're starting to see some of those M&A transactions. Majority of these transactions have been happening I would say most between seniors or mid-tiers and seniors, we're not yet seeing the money flow down to the bottom of the industry. In my view, it's a matter of time. And if I would point out, I would say that, again, it's my opinion, but I do think our time has come in terms of investing in the space and seeing that blue line finally starting to move. Another thing, which is my last chart, that I think it's incredibly bullish, and I should not dismiss in this whole presentation, is silver. And it's hard to ignore what's been happening with silver prices recently. Silver has been incredibly bullish types of behavior. When gold prices fall 1.5%, you see silver acting very well. When gold is flattish, you see silver actually starting to rise. And silver is now flirting with 33 to 35 level dollars an ounce. And what is, again, very interesting about this whole thing is that the gold to silver ratio is still at 90. And so that gives you sort of a sense of, what it could be ahead of us, meaning a 90 ratio of gold to silver ratio. For those who don't know, it's one of the largest levels in history. And usually you tend to see at least half of that ratio. In bull markets, it could be even a 20 level or so, which would imply crazy prices on silver, obviously. But my point is, even when you adjust silver relative to money supply, which was you looking at the screen, I believe we're at the very, very early stages of, a pretty significant, upward trend that I think will be the case in the following years. And so this is why I focus so much on this. I guess is a good thing that Crescent has as well a large position or the largest institutional holder of St. Cristobal, and which is the fourth largest silver mine in the world today. So it's really exciting to have that leverage to silver, in my opinion. But not only that, I think there's plenty other instruments that not only we have invested, but other folks have invested too, that are yet to reflect a period of a very bullish prices for silver. Again, I just want to make sure these are not hypothetical views. It's just my opinion about my analysis of looking at the data historically, fundamental analysis on these companies. And where my macro opinion is growing conviction on all these things. But pretty much I would say that everything now is evolving through this US dollar view as well, which I think it's one of the most important things happening in the market.